Cyber risk is often discussed in technical terms, but boards make decisions in financial terms. If cyber is a business risk, it must be understood in money, not just incidents, alerts, or system metrics. In this video, we'll look at how cyber risk can be translated into financial impact and why that changes decision-making. Boards are often presented with cyber reports full of technical detail. Threats, vulnerabilities, patch levels, important, but not always meaningful at board level. Technical data alone doesn't answer the question that matters most. The real question is simple. What does this mean for the business? How much could this cost us? What's the potential impact on revenue, profit, or cash flow? Without financial context, it's hard to prioritize risk. When risk is expressed in financial terms, it becomes comparable. Cyber risk can be weighed against other business risks, like supply chain disruption, regulatory change, or market volatility. This helps boards make informed, balanced decisions. Cyber incidents can create costs across the business. These often include business interruption, incident response and recovery, regulatory fines and legal costs, customer loss and reputational damage. Not all costs are immediate, but they are real. One practical way to quantify cyber risk is through scenarios. Instead of asking, "Are we secure?" we ask, "What happens if this occurs?" For example, a ransomware attack on a critical system, a data breach involving sensitive customer information, a prolonged outage caused by a third party. Each scenario can be translated into financial exposure. How long would operations be disrupted? What revenue would be lost? What costs would we incur to recover? This turns abstract threats into tangible business outcomes. Not all cyber risks are equal. Financial insight helps boards focus on the most material risks. Prioritize investment where it matters most. Avoid overspending on low-impact issues. This is about proportionate, informed decision-making. Quantifying cyber risk isn't about predicting the future perfectly. It's about gaining reasonable insight, not false precision. Ranges, assumptions, and scenarios are often more valuable than exact numbers. Boards don't need to calculate cyber losses themselves, but they do need confidence that financial exposure is understood, assumptions are reasonable, decisions are evidence-based. This is a governance responsibility. Every organization has cyber-related financial exposure. The question is not whether it exists, but whether it is understood and managed. Without this visibility, prioritization becomes guesswork. The Board Cyber Risk Review Scorecard helps boards assess how well cyber risk is understood, including financial impact. It highlights strengths, gaps, and areas needing attention without technical complexity. Take the scorecard to understand how cyber risk could affect your finances and where to focus next. By taking the scorecard, you assess your readiness, get instant results, receive a full PDF breakdown by email, and book a free Board Cyber Risk Review call. Like and subscribe for more cybersecurity tips and hit the notification button so you don't miss future videos. The link to the Board Cyber Risk Review Scorecard is in the comments. Take it today to see where your organization stands and strengthen your protection against future threats.